All right, today we're going to pull back the curtain on probably the single most watched number in all of finance, earnings per share, or EPS. You hear it everywhere. It's the headline number that can send stocks soaring or crashing. But what is it really telling us about a business? Let's get into it.
So think about it for a second. If you had to take the temperature of a huge, complicated company, but you only get to use one thermometer, what do you measure? I mean, that's a massive question, right? But for a very long time, the financial world has had a go-to answer.
And yep, that answer is earnings per share. It's been treated as the ultimate bottom line number, the pure measure of profitability, all boiled down into one easy to digest figure. But is it really that simple? Let's find out.
Okay, so first things first, we've got to understand why EPS became the market's favorite number in the first place. Its power really comes from this perceived direct link to a company's health and, of course, its value to shareholders. And this quote, it just nails the core idea. The logic seems super simple, right? More profit per share must mean a more valuable share. And that right there is the fundamental reason investors and analysts are just so obsessed with it. A rising EPS is seen as the clearest signal you can get that a business is healthy and growing. So how do we actually get to this magic number? Let's break down the most common version you'll see, which is called basic EPS, and take a look at what's really inside the calculation. Okay, so the top part of the fraction, the numerator, it starts with net income. That's the company's total profit. But then we subtract something really important, preferred dividends. Now, think of preferred shareholders as kind of having first dibs on the profits. By taking out their slice of the pie, we're left with the earnings that are truly available for the rest of us, the common stockholders. And that's the number we really care about. Now for the bottom of the fraction. We can't just use the number of shares that exist at the end of the year because that number can change all the time. Companies issue new stock, they buy back old stock. So to be fair, we use what's called a weighted average, or WASO, to get an accurate picture of the average number of shares that were out there generating those earnings over the whole period. It's all about making sure the profits and the shares are on the same timeline. So, basic EPS, that tells us the reality as of today. But what about tomorrow? I mean, companies often have things floating around like stock options or convertible bonds that could create a ton more shares in the future. And that brings us to a much more conservative measure. This slide lays it out perfectly. Basic EPS is the here and now. Diluted EPS, on the other hand, is the cautious what-if version. It's asking, hey, if every single one of those potential new shares were created today, how much would our slice of the pie shrink? In other words, how diluted would our earnings per share get? It's the worst-case scenario, and regulators make companies report it for a very good reason. So where do these potential new shares even come from? Well, the usual suspects are things like employee stock options. Then you've got convertible preferred stock, which can be swapped for common shares, and also convertible bonds that can be turned into stock instead of being paid back with cash. Now, this is where it gets kind of interesting. Accountants have these very specific hypothetical ways to calculate all this. For stock options, they basically pretend the company uses the cash from the option to buy back its own stock. For convertible debt, they pretend the debt was converted, which means they get to add back the interest expense they would have saved. It's a little complex, but it's a really logical thought experiment to create that worst-case snapshot. Okay, so now we know how to calculate EPS. But how do we actually use it? Let's see how this one number becomes the foundation for one of the most famous valuation tools in all of finance. The number one way EPS gets put to work is to calculate the price to earnings, or PE ratio. It's super simple. You just take the current stock price and divide it by the earnings per share. What this tells you, and this is the key, is how many dollars the market is willing to pay right now for just one single dollar of that company's profit. So high PE suggests investors are really optimistic. They're expecting big growth in the future. But that optimism is risky. If the growth doesn't show up, the stock price can fall hard. On the other side, a low PE might signal a bargain, right? An undervalued value stock. Or it could be a warning sign, what analysts call a value trap, a company that's cheap for a very, very good reason. Now, here's a little secret. Pro analysts know that the EPS number a company reports can be, well, noisy. A company might have a huge one-time gain from selling off a factory, for instance. That makes EPS look amazing, but it has nothing to do with the actual business. To fix this, they calculate what's called a normalized or adjusted EPS, basically stripping out all those weird one-off events to see the true, sustainable earning power. And this brings us to probably the most important part of this whole discussion. EPS is a powerful number, no doubt, but it can also be a tool for, let's call it financial engineering. Let's look at the biggest red flag of them all. Okay, so let's imagine a company. In year one, it makes $10 million in profit, and it has 10 million shares out there. The math is easy. Its EPS is exactly $1. Nice and stable. Now, let's look at year two. The business itself doesn't get any better. Profit is still flat, right at $10 million. But management decides to use its cash to go out and buy back 20% of its own shares, shrinking the total share count from 10 million down to 8 million. And here is the magic trick. That same $10 million in profit is now divided by only 8 million shares. The new EPS is $1.25. That's a 25% growth in earnings per share. The number looks amazing. But this is the question you have to ask. Did the underlying business actually perform any better? No, not at all. The profit was identical. The EPS growth was completely manufactured, just by shrinking the denominator. This is by far the most common way EPS can fool you.
And this buyback trick is just one of several blind spots. As you can see here, EPS is based on accounting profit, not real cash, so it can hide cash flow problems. It also tells you nothing about the debt a company might be taking on to afford those buybacks. The good news is, for every one of these limitations, a good analyst has a countermove, another metric to get the full story.
So the takeaway here isn't to just throw EPS out the window. Not at all. It's about using it intelligently. It's about looking past that headline number and starting to ask the right questions. Here's how you can start to think like an analyst. Yeah, you start with the reported numbers, but you don't stop there. You adjust them to find the core profit. You investigate that share count. Is the growth real or is it just buybacks? Then you check if those earnings are backed up by actual cash. And finally, you look at the balance sheet to understand the debt and the company's overall efficiency.
And that really is the ultimate takeaway. Earnings per share isn't the final answer on a company's health. It's the first question. It's the headline that should make you want to read the whole article, to dig deeper, and to understand the real story hiding behind the market's favorite number.